The Tom Woods Show, episode 745.
Prepare to set fire to the index card of allowable opinion. Your daily dose of liberty education starts here. The Tom Woods Show.
If you're a homeschooling parent and you're tired of running yourself ragged, then check out the self-taught Ron Paul curriculum. And check it out through my special link where you get 3 free bonuses totaling $160. My special link? RonPaulHomeschool.com. Hello, everybody. Tom Woods here. Fractional reserve banking is the topic for today, just because we haven't done it yet, and I'd like to talk about it. What's the deal in terms of the economic consequences of fractional reserve banking? That's a controversial question in some circles, and we're going to tackle it today with Jeff Herbener, our old friend who is chairman of the Department of Economics at Grove City College, which, by the way, is where Hans Sennholz taught, if that name rings a bell to you. He is also associate editor of the Quarterly Journal of Austrian Economics and a faculty member at mylibertyclassroom.com. Could you imagine, by the way, having a whole year, being able to ask this guy any economics question you have for a year? Think about what you would pay for that, and I guarantee you it's way, way, way less at libertyclassroom.com. Jeff, welcome back to the show.
Hey, thanks, Tom. Great to be here.
Here we are in the 740s of episodes, and I've had people asking me for an episode on fractional reserve banking since episode number 1. And all I can say is, look, I've been busy. All right? So here it is. And we're going to talk not about the legal status of it or, engage in philosophical speculation about it, but instead just the economic effects of fractional reserve banking. And even here, as you've pointed out, there's controversy even among some people who call themselves Austrians. So we're going to try and sort all this out. Now, you were on here some time ago, and I'll link to this episode. I'll link to all your previous episodes, where we talked about what the monetary system would look like with complete separation of money and state. So I am going to refer people to that episode to get the full picture of what a purely free market in money would look like. But I wonder if you think that's relevant? Do you think it would help to paint that picture in order to help us understand the topics we're going to be hitting today?
Sure.
All right, so why don't we just, you don't have to give you don't have to worry about a whole lot of definitions or technical detail. Just give the basic overview, and then if people want more, they can listen to that earlier episode.
Right. So the basic argument is that the efficiency of production of anything on the market is determined by profit and loss. And every viable production process must cover its costs of using resources with the revenue that it generates. And so this would be no different for money production than anything else. So on an unhampered market economy, we'd have entrepreneurs who run businesses producing commodity money, and they would bear the cost of mining the commodity and minting the coins and so on and so forth, just like any business. And then that production would be integrated into the production of all other things in the market economy, and that would create efficiency in the production of money itself.
Now, just again, as I say, we've already covered this in a previous episode, but it was hundreds and hundreds of episodes ago, and I don't want to presume everybody has listened to every episode, although it's a wonderful thing to aspire to. I'll say that. It's hard, I think, for people to understand where the profit comes from in the creation of money. If we're talking about money as a good that can be created on the market, it's harder, I think, for people to see where profit comes from than it is to see where profit comes from in shoe production, because there I see that profit and loss regulates that. If I produce too many shoes, profits go down. If too few shoes are produced, there's a profit opportunity for somebody to come in there and produce the shoes that the market demands. And eventually there's a point reached at which it doesn't make sense for there to be new entrants into the shoe market. But how does this work with a money market, so to speak?
Right. So it actually just cuts out the last step of earning profit. So any producer engages in all these costs of production, they buy all their inputs, and then they produce the product, and then they take the product and sell it to the customer in order to generate money revenues. So with a money producer, the money producer just buys all the inputs, and then produces money itself. And so it's just a question of not having that last step of having to sell a good for money in order to realize the profit. And then this, as you suggest, the same adjustment process in the price of money or the exchange value of money would take place if it's overproduced. If it's overproduced, then its value in the market would fall, and then the profit would be eliminated.
So that's why it wouldn't make sense for me to just – it seems like the sky's the limit. I would just want to keep producing and producing and producing. But you're basically saying that the factors of production that I would need to produce the additional money would be bid up to a point that the expenditure of those resources would outweigh the benefits I get from the money produced.
Yeah, that's exactly right. So as you produce more and more money and it's spent into the market, then the prices of all things rise. And so the purchasing power of the money itself goes down. And so we get exactly the same kind of adjustment process that eliminates the profit of any production in the market economy if it is extended too far.
So we're assuming that the money being produced would be hard money, would be a precious metal that it would actually take physical effort to produce, and I would need factors of production to produce it.
Yeah, that's correct. So that's how money would initially get started in the market. And then, or we could, if we wanted to go back to a market system of money, we could initialize that system. And then the development of a money product would be open to entrepreneurial innovation. And so entrepreneurs could innovate just like they would in any market, given the money system that exists and this commodity money system that exists. And we might get new money products in the future.
All right, now let's talk about fractional reserve banking. And this is an idea, you learn this in basic economics, you learn how it works. You're not presented with the possibility that there might be downsides to it or there might even be a debate about it. In a mainstream economics course, you don't get anything like that. What you get is that this is simply obvious, that this is how banking works and presumably this is how it ought to work. Now, I've seen your presentation on this, and you have T accounts, and you show what would happen in a system of 100% reserve banking when a loan is extended, and then what happens in a system of fractional reserve banking when a loan is extended. Can you try and go through that just very basically and quickly? Because then I want to go into what could be wrong with the fractional reserve system, especially if I don't want to get into the philosophical question. If people consent to it, then it's okay. That's not really what we're arguing. We're arguing does it have economic problems associated with it. But first, let's look at what's the difference. What's happening in the economy and what's happening with the bank when a loan is extended in both of these cases. And I guess in answering this, we should explain what fractional reserve banking is in the first place.
Right, sure. So let's start with the 100% reserve banking in the unhampered market. So here, in order for a bank to extend a loan to a borrower, the bank would have to borrow the funds from someone who is willing to save. And so we have things, even in our economy, like certificates of deposit and passbook saving accounts and so on. So that's how the loan is intermediated. The bank is just a middleman in borrowing the funds from savers and then lending those funds to investors. And that's an entirely separate operation for them to perform as opposed to the production of money certificates. So we'd still have checking account balances and, we'd be able to open up checking accounts at banks. But the banks would, in the unhampered market, keep 100% reserve of money against those deposits because here we're not making a loan. When we have a checking account, we want readily available money balances to spend, and the checking account form of these balances are oftentimes for people more convenient than lugging around the commodity itself. So here the banks can be profitable in that operation of providing 100% reserve checking account deposits by charging customers fees. And then in their loan operation, they would earn an interest rate differential as their revenue stream that would cover the costs of their financial intermediation. So they pay savers a wholesale interest rate, and then they lend at the retail interest rate. So that's how it would work on the unhampered market economy. Now, in a fractional reserve system, The banks do not need to intermediate all of their credit. They can just create credit by putting loan balance funds, just writing these funds into people's checking account. So here we get a disruption of the way in which the unhampered market economy activity, this financial intermediation and money certificate production are within the bounds of economic calculation and efficiency.
All right, before we get into the potential problems with fractional reserve banking, I guess this question is going to lead to a problem. But I think the question a lot of people have, again, leaving aside the is it fraudulent and all that stuff, just the basic question of if there's this money sitting in the bank and it's just sitting there, nobody's using it, it's just sitting there. Now, presumably, yeah, let's just put it that way. The money's sitting there, I've deposited it, and technically, yes, I am entitled to get it on demand, but probably I won't go get it most of the time. Most of it will just be left sitting there. Isn't that unproductive? Wouldn't it be better in the meantime for somebody else to use that money to go build a new factory, to go employ people? Your system would just have that money lying there idle, whereas I can put that money to work because with fractional reserve banking, the bank would be allowed to lend that money out, and that would make people more prosperous. Now, let me put in parentheses. It's not to say that in a 100% reserve system, the banks could never lend. I want to make sure everybody understands that. We're not saying that the desirable system is one in which no loans can be made. It's just that the loans would be made under conditions where the depositor understands that he forfeits control over the money for a period of time. The fractional reserve system is a system in which the money is being lent out that these people are entitled to on demand. That's the difference. But my question is, if that money is sitting idly in the bank, wouldn't it do mankind better if it were circulating out in the economy? What's the fallacy involved in that?
Yeah, the fallacy is, of course, that every productive activity on the market economy is justified by satisfying consumer preferences. And so if consumers have a preference for having a deposit for safety reasons kept stable and available for their expenditure at any point in time, well, then that's what the bank should do. And if they want to lend, if they have time preferences, as we say in economics, and they desire to lend, then the bank would provide, as we discussed already, this financial intermediation function. So it actually isn't efficient to extend loans to entrepreneurial projects beyond what consumers' time preferences are. If we do that, then we'll actually get inefficient use of the resources in these investable projects. I mean, if we thought it was proper to have fractional reserve funding of investable projects, we might as well just have the state step in and fund every project. Why not just print money and fund every possible project? Hopefully, again, it's obvious that doing that would not be efficient.
Let's then go through and look at what some difficulties are, some economic problems caused by fractional reserve banking that are not caused when loans are written in a 100% reserve system, in which any money substitute, like paper money, exists in a 1-to-1 ratio with gold in the vault. So, what are some of the problems? Is the business cycle created by fractional reserve banking?
Right. So that's one of the economic implications of the issue of these loans in a fractional reserve system. But we might start with a more simple problem. The financial integrity of the banks is affected by this. So the banks, when they issue fractional reserve balances, are immediately illiquid. So they have on-demand liabilities that customers can come and present to them at any time, and yet the assets that balance off those liabilities have time dimensions to them. They've made loans with a time dimension. And the related feature of this is that in a 100% reserve system, as we've mentioned, the total amount of funds available to the banks to make loans will be lent out in an economizing way to the best customers and the best projects they can find. So now if they engage in fractional reserve lending on top of that, they'll have to make these loans to less creditworthy borrowers and projects that are less likely to pay off. And so the financial integrity of the whole banking system gets affected by the fractional reserve nature of the banks. And then, as you suggest, the broader economic effects on the economy as a whole, the fractional reserve system then permits this credit creation process, which, as we mentioned already, extends investable projects into areas that they wouldn't be extended otherwise, and sets in motion this process we call the boom-bust cycle.
You know, Jeff, before we go on, it occurs to me that I had a bit of a dispute with John Tamney, who's a very good guy over at realclearmarkets.com. I like him a lot. He's very much a friend of the Austrian school. But he totally disagrees not only with our judgment about fractional reserve banking, but he thinks that even our understanding of how the whole system works is not right. And it occurred to me it might be fun to bring John on and have you on and get you two to hash this out. Would you be willing to do that?
Oh, sure. That'd be great.
Oh, good.
Yeah.
Oh, I'm going to write to him. And now, look, now you all know, everybody listening, you all know the challenge has been laid down, and we'll see if John is willing to rise to that challenge. We'll get him. Oh, the Tamney-Herbener cage match is going to be the event of the century. It really is. All right. So we'll do that. Before we go further, let's assume that you're right, that fractional reserve banking can cause these problems in the economy. The Fed, we know, can cause these problems in the economy for the same kind of reasons. But the Fed is an artificial creation of the government. The Fed is not a spontaneous creation of the market. But yet you could argue, well, again, this is just devil's advocate, but couldn't you say that fractional reserve banks, though, are a creation of the market? And so aren't you saying that a creation of the market could lead to the business cycle? So then how do we think about that?
Right. So part of the problem is that since we don't have a free market economy, the actual existence of fractional reserve banks isn't empirically verified as part of the market economy. Right. We're not really sure if we had a completely unhampered market economy, if fractional reserve banks would arise in this economy, and we can think of what the problem would be. Let's suppose we have an unhampered market economy that where money just develops and we get this initial system that we've described before, and then we try to think about the possibility of a fractional reserve bank starting up within the matrix of a commodity money and 100% reserve banking. So here the difficulties are apparent. It isn't obvious why customers, let's say merchants at large and so on, would accept payment in fractional reserve notes, given that other customers are paying with 100% backed checking account balances. So there is a kind of difficulty that we can't settle empirically about the logic of the actual existence of fractional reserve banking in the unhampered market.
So, in other words, the sense that I get from Joe Salerno these days is, well, let's test it out under real conditions where there would be no bailouts, no deposit insurance, no interventions in the market. It would just be pure competition between institutions, and then we'll see what happens. Mm-hmm. And then in those conditions, then you would indeed be likely to see what happens. Well, what about the related question? If 100% reserve banking is so desirable, why don't we see any institutions offering that service?
Well, again, as you've already suggested, the advantages of operating with fractional reserves in this protected environment far outweigh the advantages of trying out 100% reserve as a business strategy, because again the downsides are covered, the costs are socialized, are covered by government intervention, where the upside is quite obvious, right? If you can issue credit out of thin air, that's quite lucrative to do, and if you're protected from the downside effects by bailouts and so on, then of course the choice of businessmen would be quite quite obvious. It's also the case that there are a couple of experiments with 100% reserve banking, even in our day and age. And so, we'd have to see, again, like Joe Salerno suggests, how that would play out.
All right, well, having said all this, let's turn to something that I know can become complicated very quickly, but I have confidence in your ability to bring it down a few notches. Because even the very term monetary disequilibrium theory makes people want to run in the other direction. But I assure you, folks, you stand there like you're sinking in molasses because you want to listen to this. This is the position taken by people in the Austrian camp, broadly considered, who say that fractional reserve banking, not only is it not objectionable economically, but it's a positive good economically, that it actually serves a useful market purpose. So I'd like you to walk through what their case is for what can the ability of banks to produce additional money do for the health of the economy.
Right. So their position boils down to the proposition that any period of extended price deflation would be depressing for production in the market. And it's quite apparent that if you had an unhampered market economy, it might be possible that the purchasing power of money would rise over time. And the only moderating effect to this would be, as we've already pointed out, the increased production of commodity money that would stimulate by raising the profitability of production. But this might not be enough to prevent some price deflation. And the monetary disequilibrium theorists have this model of the economy that implies that any price deflation would be problematic for entrepreneurs to adjust to. And so their conception of the fractional reserve system is that when money demand increases in a fractional reserve system, these unbacked money substitutes, additional checking account balances through lending, could be immediately increased in order to offset or balance out this movement of increased demand for money that would otherwise lead to a price deflation, an increase in the purchasing power of money, and a series of price deflation.
Can I just clarify one term for non-economists? When you say demand for money, a lot of people will be confused about that. They say, well, everybody has an infinite demand for money. We don't mean it in the colloquial sense. We mean it in the sense of if you had $1 million, probably you'd start spending it, which goes to show you don't have an infinite demand for money. You have a demand for other things, too.
Correct. So the typical way we use the term in economics is the demand to hold a cash balance. That's our demand for money.
Right. Okay, okay, good. Yeah, that's good. Hold a cash balance. All right. Now, this raises two questions I want to follow up on. First, I want to follow up with why do these theorists think that falling prices will be problematic for entrepreneurs? Isn't that the role of the entrepreneur, to anticipate price movements? But secondly, then I would, of course, want to know what is your response to this thing, this claim that fractional reserves solve this problem. First, I want to see whether it really is a problem. And then secondly, we'll, just for the sake of argument, we'll stipulate that it is a problem. Why does fractional reserve banking not really work? Actually, I'm not even sure if I'm phrasing this right. Let's do one question at a time. Let's go to because we have talked about deflation before. Mm-hmm. Do you think that the problem that they're presenting is in fact a problem?
Well, no, I don't think so. As Joe Salerno has pointed out, the downward stickiness, so to speak, of prices of factors of production, or prices of goods for that matter, is at least in part a business strategy of the entrepreneur. So entrepreneurs tend to leave retail prices, for example, at a stable level and let demand variations be absorbed in their inventory build up and rundowns. Because this is what customers want. They don't want, instantaneous, continuously moving prices throughout the day as they're buying in Walmart or they're online buying clothes or whatever. So this is partially just a business strategy, which could, of course, change in the face of an extended period of price deflation. The other thing that moderates this concern about price deflation depressing business activity is, let's suppose we did have a case where the prices of an entrepreneur's output were falling, and he tries to adjust the prices of his inputs by lowering the wage offer he makes and so on, but he's unsuccessful in retaining his labor force by doing this because the workers just leave and go to other areas where the demands aren't decreasing, let's say. Well, those aren't, I mean, if labor wages are sticky, other factor prices are not sticky. So in particular, his asset prices would not be sticky. The assets that he owns, their prices would in fact be variable. And that's what stock markets are for, is for outside investors to buy and sell claims to the assets of companies to adjust their prices to the correct level of the demands for their products. And so the lowering of the asset values would, for an entrepreneur, would lower his cost structure, and his profitability of production would be restored. He'd suffer a capital loss, but the ongoing production would still be viable.
All right. Now, so here's the question that I was very awkwardly trying to see. I'm honest here. I didn't edit that out. I just kept it in there. Just couldn't quite think it through. It seems to me that the monetary disequilibrium theorists, by proposing fractional reserve banking as a solution to the dislocations caused by falling prices, well, we'll just pump money into the economy, that'll level out the prices, and then entrepreneurs won't have all this confusion and trickiness and price stickiness to contend with. We'll be able to have a smoothly functioning price system once again. Okay, I don't want to take the words out of your mouth because I've heard your response to this. What's wrong with that? And is this kind of like not only is it a solution in search of a problem, but is it actually like a downright negative in search of a problem?
Yeah. Well, let's deal with the direct claim first. Whether or not in the conception of a fractional reserve banking system, you can have this kind of flexibility of the overall production of money substitutes. So that is a contentious point in and of itself. So Joe Salerno points out, relying on Mises's previous argument, that if you have truly independent banks, let's say you have independent banks each owning their own gold money reserve against their checking account balances, that the competitive pressure of other banks in the system would prevent any one of the banks from issuing almost any unbacked money substitutes whatsoever. And that even if the demand for money went up, they wouldn't be able to keep these additional money substitutes in circulation, because they would just be, if they did this, if they ran their reserve down, let's say from 90% to 80%, these unbacked notes, these additional unbacked notes would just be accumulated in the hands of their competing banks, who would then turn them back for redemption as an act of competition against the bank that overissued. So it's not clear that in a system of independent banks you could have any fiduciary issue at all, even if it were legally possible to do it. So the only way that it could be done is to have a banking system where there's some sort of agreement among the banks that they'll not engage in this kind of competitive behavior, or that they'll accept all the different competing bank checking account claims at par or something of the sort. But once you do that, then it doesn't seem possible to regulate the issue of fiduciary media or these unbacked notes. It doesn't seem possible to regulate that by redemption claims. Because again, what will happen is if banks, let's say, increase the credit supply by 10%, this will push interest rates down. And so those projects will in fact be funded. And then when that additional money is spent, it will lower the purchasing power of money. It'll make prices go higher. And then people will actually want to hold all those additional all that additional newly created money. And so they won't redeem it to the banks if this is an overissue. They'll just want to hold more money as the purchasing power of money is pushed down.
So it can't work, in other words. Even in their scheme of things, this wouldn't work. People wouldn't act that way.
That's correct. It seems at least problematic.
Yeah, so no, it's not obvious that this is the solution to this alleged problem.
That's right. In order for it to work, the issue of unbacked money substitutes would have to be regulated to exactly meet demand, and that seems entirely dubious.
Should we, rather than be cagey about it, should we name some names here just so people know whom we're talking about, who would be examples of monetary disequilibrium theorists, or do you think that's too inflammatory?
It's your show, Tom. So flame away if you want.
Well, yeah, nothing's too inflammatory for this show. Although, isn't that funny that here I am thinking I'm being really edgy because I might name some monetary theorists on my show. Yeah, I would say let her rip, Jeff. Go ahead.
Well, the advocates of this view, one prominent advocate is George Selgin, who's written extensively in this area. And Steve Horowitz is another, who monetary disequilibrium theorist who argues along these lines. So those are two fairly well-known among our circles proponents of this view.
Okay, good. I don't know. Maybe we could debate that someday. Who knows? But first, we got to get Tamney on here. Boy, would that be a lot of fun. I would really enjoy that. And I would be, as people know, I've done a lot of debates on the show. I'm an honest moderator. Even when my own sympathies are known, everybody participating admits that, yep, he was good. So we'll make that work, and I won't make my obvious preference for your position known too obviously in the course of it. But anyway, all right, well, great talking to you, and I'm so happy that you got Dave Howden there with you. I can finally talk to him in the same time zone that I live in now that he's in the United States for one semester.
Yeah, we're really fortunate to have him. He's doing a great job for us. It's great to see him.
Well, he is going to be, this is episode 745, so tomwoods.com/745 is the show notes page for this episode. And then Dave Howden, if all goes well, should be /746. People who haven't heard of Dave Howden, I'll just tell you, I think, and I got to know him back in 2008, and the very first night I had dinner with him, I thought to myself, this is going to be one of the best up-and-coming guys we have. And nothing has happened to change my mind about that. So I'm glad that you guys snagged him at Grove City for a semester. All right. We'll talk again soon, Jeff. Thanks for your time.
Thank you, Tom.
All right. I have a funny story to tell you about my 13-year-old and the Articles of Confederation. But before I do that, let me tell you about a brand new site, another site created by a Tom Woods Show listener. This one is a guitar website that helps you to learn guitar. It's got all kinds of great free material there. It's called Shreddable.com. The word shred and then I-B-L-E, Shreddable.com. And the way the creator of the site put it to me in an email, he says, as Carl Sagan said, when you're in love, you want to tell the world. And with my blog, I'm doing just that. At Shreddable.com, my aim is to teach guitar and music theory concepts to the layman in a way that is simple, or at the very least, I hope entertaining. I also provide licks as well as tips and tricks to make for a fluent, more confident player. So check out Shreddable.com. Great diversity of sites being created by people who listen to the show. And remember, you get all kinds of free goodies if you get your hosting through my link. Many, many goodies, including membership in my exclusive private bloggers group. We now have over 100 members. We're in there plotting. We want you to join us, so check out the details of that special deal at tomwoods.com/publicity. This is September 26th, 2016, as I record this. Today and tomorrow, it's another flash sale at Bluehost. They're making hosting available for just $2.95 a month, $2.95 a month. It's crazy, so go over and grab that, but check it out at tomwoods.com/publicity. All right, anyway, the other day I was talking to Regina, my 13-year-old, and it had come to her attention that the general consensus about the Articles of Confederation was that it was a big failure for all these reasons, that it didn't give the central government enough authority, and it couldn't come up with coherent policies, and it couldn't tax, and it had all these weaknesses. And Regina said to me, I was thinking about it, and I thought all these alleged problems sound to me like strengths. And I thought, man, she's 13, and she's already got her head screwed on better than I did probably when I was 20. So tremendous. Wonderful to hear that. All right, coming up tomorrow, Lou Rockwell and I will be talking about the presidential debate Donald Trump versus Hillary Clinton. We're going to be talking about that episode 746. That's tomorrow. We're going to get that out as early in the day as we possibly can, so we got that going on. Then episode 747 is going to feature Dave Howden coming back to the show, and we're taking on an argument that a show listener has been having with a friend. And this friend says, what's the point of lowering taxes, particularly on the rich, when the rich are just going to take that money and they're going to put it offshore, they're going to send it overseas and shelter it from taxation and whatever, and they're not going to do anything with it. They're just going to keep it there. Whereas workers, they'll actually go out and spend the money, and that's the driving engine of the economy. Are workers who go out and spend the money, because the spending of the money is what makes businesses profitable, and this is what we need more of, is people who just go out and spend that money. So they look at the economy as being just pieces of paper changing hands over and over again. That's the entire model of the economy that they see. But we've all heard a form of this argument at one time or another, and Dave Howden and I are going to take a crack at answering it for you in episode 747. I'm also setting up an anarchism-minarchism debate with Walter Block and an opponent to be determined, so that's going to be fun too. All kinds of things. How can you not be subscribing to this show now? Come on. Come on now. Subscribe over on iTunes or Stitcher to The Tom Woods Show. Look at all these goodies you get every day. Thanks for listening. See you tomorrow.
Become a smarter libertarian in just 30 minutes a day. Visit TomWoods.com to subscribe to the show for free, and we'll see you next time.
You're not going to believe this. My cat is chewing on one of my foam earplugs, and I got to make sure that she doesn't eat it. Okay, all right. She had the good sense not to. But, I mean, I don't want the cat to die. I mean, I have to.
No, technical difficulties,
Yeah, sorry. Just crazy. Okay, all right. Now, finally, the last thing. Here we go.